Thanks for joining us today on Market Call. I'm Morello Fernandez. Christine Poole on the show today, President and Co-Chief Investment Officer at Davis Rea. She'll take your questions on North American large caps. Here's how to reach us. 1-855-326-6266. If you want to dial in, you can email your questions, Market Call at bnnbloomberg.ca. Good to see you. Thanks for coming in.
Thanks, Morella.
Let's talk a little bit about the price of oil. It's been hovering still under the $100 mark.
Correct.
I've been looking at West Texas Intermediate.
Yes.
And I'm wondering if, with the markets rebounding the way they have the last couple of days, you think investors are over the initial shock of the conflict in Iran?
Well, I think it's just encouraging that we know through the Strait of Hormuz that some vessels have been allowed to pass through from, I guess, Iran would call from friendlier nations. They're not U.S. So I guess that's somewhat encouraging because it means that there is some crude and refined product getting through. So that may, potentially dampen the oil price increase if the war continues to go on for a prolonged period of time.
I was going to say, do you think investors are believing that perhaps this is going to be a short-lived conflict and that is also weighing on the price of oil?
Yeah. I think that generally speaking, Morella, because the reaction in the markets, you're right that we've pulled back, but really it's been whatever, like a 4 or 5% correction. It's not been that severe. So I do think probably that markets are thinking that it won't be prolonged, like meaning months. We know that the U.S., obviously, their firepower is much stronger than Iran's. So if and when Trump decides to maybe pull out, then we would probably see some de-escalation of what's going on over there. And as well, he has to also be aware of his own constituents back in the United States because gasoline prices have gone up over 20% at the pump. And U.S. consumers don't want that. Affordability is already an issue they've been complaining about. His popularity rating at the polls has gone down dramatically, and he has to think about the midterm elections coming up later on in the fall. So I think there's a feeling that he will maybe pull out sooner rather than later. But everyone's just speculating really at this point. And
it really is gas and groceries that people look at when they're determining how affordable life is right now.
That's right. And we've seen fertilizers. Once again, that's a product that gets transported. And if fertilizer prices spike up, and they have, then that eventually will filter down to the food chain. And to your comment about groceries at the store, that potentially could have an inflationary impact on groceries.
Have you adjusted at all in energy because energy has seen a spike? Have you trimmed at all in any of your investments?
Well, see, we have stuck primarily to pipelines in the energy sector. So we haven't bought producers. They're not in our portfolio. So we haven't gone ahead and bought the producers in anticipation that oil prices stay elevated because that could actually backfire relatively quickly. So we're actually happy to kind of keep our exposure in that area in the pipeline sector.
Okay. Let's line up some phone calls and some emails for Christine Poole of Davis Rea. Once again, she's taking your questions on North American large caps. Here's the number to reach us. We're back in just a moment. Welcome back. We're going to start with an email from Corey. He says, I'd like to ask the guest thoughts regarding Adobe. Is it a buy, sale or hold? Adobe did report earnings. I think it was just last week.
Yes.
They've done okay, but investors have really been pressing back on their business for a long time now over software concerns. Where do you land on this?
That's not a stock that we own, and I'm not looking to add it to client portfolios. You're right, Morella, that artificial intelligence and those tools are, an overhang on the stock because, they create digital content, videos, et cetera. And with AI, these tools can do them faster and maybe less costly. And so potentially, less people wanting to subscribe to Adobe's software. And so that's been weighing on the stock along with a lot of other software stocks. So it's not trading at a very demanding multiple, and it's still growing. However, I think when you referenced, they reported last week, their CEO is also going to be retiring. And he's been at the helm of the company for 18 years and has, did very well with the company over the past 18 years.
Does that signal anything to you when he's...
Well, see, I think that came as a surprise to the street, and no one likes surprises. And so the next question is, well, who's going to, take its place, and how is he or she going to chart what's going on now in the current environment? Because it's a lot more uncertain as to their future growth outlook. So I think that the stock also pulled back on that news. And so I guess until we have more clarity as to who is going to be the new CEO and does he or she have a new strategy for the company, that's all questions that remains to be answered.
Okay, so more of the unknown for the company Adobe. All right, let's get to our first caller. Chris is on the line in Delta, BC. Hi, Chris.
Oh, good morning, Morella and Christine. Thank you for taking the call as always. Christine, always a pleasure when you come on the show. I'm calling today about Thermo Fisher Scientific. It's retraced actually quite a bit in the last couple of months again. And I'm wondering, it's sort of that picks and shovels way to play the healthcare space. And I've been averaging down as it's been coming down. And I'm wondering if this is a dip that you would be buying, or if you have another name in the healthcare space to express that exposure. Thank you so much and have a wonderful day.
What are you doing in the healthcare space these days?
Well, we do have some healthcare holdings, and it is considered to be relatively more defensive, but it's kind of been, not sure if that's really been the case right now. And we do own Thermo Fisher in our client portfolios. And I would be adding it on this pullback. I think going into 2026, the feeling was that the spending environment was going to be more positive because rates were lower. Because in prior years coming out of COVID, where Thermo actually benefited through that, there was a headwind because they lost, obviously they were potentially over-earning because of what was happening with COVID and the business they got from that. Yes. And then we had higher interest rates. And so, funding for biotechs was not that strong. So that was a headwind to spending. And I think going into this year, there was a feeling that that was moderating because rates were lower. And, biotech companies and pharmaceutical companies as well were really investing in their pipeline to offset, things going off patent. And I think more recently, perhaps the reason why it's pulled back is the anticipation with this war that's happening that it may result in inflationary pressures, which would mean that central banks will not be raising interest rates. I know in the U.S., initially, I think most analysts were anticipating we'd have a couple more cuts. Now it's kind of on the sidelines that, unemployment is kind of weakening, but inflation is still not at their 2% target. And then if we actually do get an inflationary spike, there is the potential that rates may be going up. So that may not be positive for the funding environment for healthcare stocks. But longer term, I do think, Chris is right, they do provide the picks and shovels to the whole healthcare industry. And so they will benefit. You don't have to choose one particular pharmaceutical company. They're supplying their services to all of them. And so that is, I think, a good way to play that industry.
Okay. Let's move to our next caller then. Cal's on the line. He's in Regina with a question. Hi, Cal. Cal, are you there? Okay, we may have lost that caller. Let's go on to Louis, who is in Toronto. Hi, Louis.
Hi, how are you?
Good, thank you.
Good. I'd like to ask about CIBC. The stock right now is at an all-time high. Property prices in Canada have fallen over 25% since 2022. That's a lot of negative equity because, people bought a lot of homes during that time. Their stock isn't reflecting this. We're entering Kuzma. Donald Trump is going to rip up Kuzma and replace it with tariffs. He wants to bring manufacturing back to the U.S.
What's your question, Louis?
I want to know what's going to happen to these bank stocks once Kuzma is ripped up in place of tariffs.
Okay, thank you for the question. So, the banks have done fairly well despite the tariffs that were introduced last year.
Yes.
Are you concerned about Kuzma being ripped up or replaced by a bilateral agreement, for example?
Well, we're speculating what's going to happen because we know negotiations will start in the next few months. And you're right that the Canadian economy probably last year did relatively better because a lot of our exports are covered under Kuzma. So our tariff regime was a lot lower than in most countries.
We didn't get hit as hard.
No, exactly, except for certain sectors, as we know that. So I think we can assume, I don't assume or speculate what's going to happen. I think there is a vested interest potentially for all countries to come to some sort of agreement because the U.S. is also, they get a lot of our goods and you put tariffs on our goods, then it just translates into higher prices for them. Now, having said that, with the banks in general, yes, we know the Canadian housing market has been weak, but that's been a known factor for many years. And I think the fact that when rates were higher, the Canadian banks were reserving, they were putting aside provisions for potential problems, and they're actually near the tail end of that, elevated reserving, I think. And so that's already, they've gone through that, and when the stocks have done, like I said, quite well. And I think it's a reflection that the Canadian economy has, we've managed through. Rates are lower now. So to the caller's point about the housing market, with variable rate mortgages now maybe expiring and coming up for renewal this year, next year, they're much more manageable than if they were a couple of years ago when rates were higher, because we've gone through the easing cycle, and arguably the Bank of Canada has indicated they may not do any more cuts. And as well, and the one positive to address Louis' concern is that we've got a lot of fiscal stimulus going on in Canada now. The government has indicated they want us to grow, and they're going to expend money to support programs for growth. Yes, near the near term, that's not going to help our deficit, but hopefully in the long run, that promotes growth. And they also want to explore new trade channels and develop that. So that's also positive. And I think when the banks reported a few weeks ago, Marilla, all the CEOs were actually talking about that, and they're somewhat encouraged. But yes, the uncertainties are the tariff regime, and now with the outbreak of war. But higher energy prices is beneficial for our energy sector. But unless it gets so elevated that the global economy goes into recession, then it's not good for anyone, right?
All right.
Yeah. So anyways, we still consider the banking group, and one of my top picks is one of the Canadian banks as an attractive income area.
Got it. Okay, let's take a quick break. We will come back with more of your phone calls in just a moment. Stay tuned. Welcome back. Let's go to Chad holding on the line. He's in Saskatoon with a question today. Hi, Chad.
Good morning, Marella and Christine. Christine, I'm wondering, do you currently own WSP Global in your fund? Mm-hmm. If not, would you consider buying it here? And for an investor who already owns the stock, would you be comfortable adding to the position at current levels?
Thank you
I'll
for the
hang
question.
up and listen. Thank you very much.
Thanks, Chad. So WSP Engineering, do you own them or anybody else in that space?
Yes, we do own WSP Global Engineering Services and Consulting. We've owned it for a few years. I'd say, probably at least 4 or 5 years. And we would be buying it on this pullback. They're very global. They grow through acquisition as well as organically. They're still seeing good growth in their end markets. They're, leading player in the environmental, in the power market. They did an acquisition last year and then their customers are all the utilities in the United States. They're seeing good growth there. And the stock has pulled back. A lot of the companies in that space have pulled back, once again, on AI concerns that somehow companies will implement AI tools and be more productive and not necessarily need as much as WSP Global Services, which management has argued that, no, that's not accurate, not correct. And I think I lean towards what they're saying, that, they oversee and advise on large projects like building bridges or
that
building
complex,
and you're dealing with multiple parties. And someone, in the end, when that design is done and built, then someone has to be accountable. So is it going to be some AI chat box? I don't think so. And so, meanwhile, WSP, they are also implementing tools within their own organization to be more productive. And I think they've actually have an agreement with Microsoft to use some of their AI tools internally, as well as on projects that require some assistance in that area. So I would definitely be buying this on a pullback.
Are they not also going to benefit, and I'm speaking more generally about the engineering firms, on infrastructure and builds out that
Yes.
everybody's interested in now?
Yes, definitely. Yeah.
Okay, so that's going to be a tailwind for them.
Correct. Yeah.
Got it. Okay, let's move on to our next caller, Doug on the line in Lindsay, Ontario. Hi, Doug.
Hi, how are you?
Good, thanks.
I wonder what Christine thinks about the price of gold. Shouldn't it be going up when there's all this aggravation in the world?
Yeah, this has been part of our conversation recently, Doug, but are you looking to invest or you're already invested?
Whether to buy or not.
Okay. Thank you for the question. So we have been talking a little bit about why it's not the safe haven that we expect it to be in times of tension and conflict.
Yeah.
So first, can you explain why you think that's not happening and whether you'd put some money in it where it is today?
Well, I think, when the conflict started in Iran, the U.S. dollar actually strengthened. It became this safe haven currency, which everyone had in the past was arguing, oh, that's not going to happen. No one's going to turn to the U.S. dollar. It has been weakening for the last year through the basket of currencies. And so it actually strengthened, which is when the U.S. dollar strengthens is actually negative for gold. So I think that kind of inverse relationship came into play. And gold's had a huge run, right? Like we know it's done very, very well. And so potentially, it could just be profit taking as well, a period of uncertainty. Who knows? There could be various reasons. Now, typically, Marilla, we don't invest in commodity-based industries, and gold is one of them. Obviously, that's looking back, we perhaps should have had a position in gold, but we never did. And at this juncture, given the run it's had, I don't.
You wouldn't put new money in.
I wouldn't put new money in. No.
Got it. Okay. Yeah. All right, that was for Doug. Let's go to Cal. Cal's on the line. He is in Regina. Cal, I think we missed you earlier. What's your question today?
Christine's thoughts on Algonquin Power, please.
Okay, thank you for the question. Algonquin Power.
Yeah, so this is a power company that's gone through a lot of change over the past few years. It ran into some difficult, it was over leveraged, had some difficulties, had to cut their dividend, but they sold their renewable power business, and now they're kind of on track to be just a regulated utility, and that's their focus. A lot of operations in the United States. I'm not, we don't own Algonquin. We have another utility that we think has a more steady track record in terms of dividend increases and visibility of earnings flow and just being better managed. And I think the company did report a few weeks ago, and I believe they brought down their earnings guidance. It was for various tax reasons. But at this juncture, I'm not thinking of it as a defensive utility investment.
Okay. Let's move on to our next caller then. We have Dave in North Bay, Ontario. Hi, Dave.
Hi, Christine and Marilla. How are you today?
Good, thank you.
My question is on Rockwell Automation. I'm looking at a general view of the company for a long-term hold in my TFSA.
Okay.
Thank you.
Thank you for the question. Can you tell me a little bit more about them?
Yeah, they do factories, automation of factories, processes, manufacturing processes.
So the big jobs.
Yeah, and so it is an attractive area to be in. This is a stock that we actually own in our U.S. equity growth-based fund that my colleague John O'Connell manages. We don't have it in our segregated portfolios, which I oversee. I do think that space, as I said, is an attractive area because it's growing. We are seeing more and more automation in everything, whether manufacturing, so many areas of the market. And Rockwell is one of the leading players in that space.
Do they layer the AI into the robotics?
Oh yeah, I'm sure they embed that into there. So. If you want something in that area, I think Rockwell is a fine long-term hold. One of my top picks that I have today, they actually play in that automation space as well. And they're a bit more diversified. It's not just automation, and they're geographically more diversified. So that's why we went with that one.
Cool. All right, let's take a quick break then. We're going to have a look at the past picks from Christine when we come back. Stay tuned. Welcome back. Let's go through past picks from Christine Poole from February 20th of last year, so just over a year ago. At the time, she chose Microsoft on the NASDAQ at 416.13 US, down out of 402.11, 3% drop, 3% total return drop. Mm-hmm. Not huge,
no.
But Microsoft and many of the big tech has pulled back. Yes. I imagine you've held on to this. Are you continuing to hold?
Oh, yes, we are. And like you're right, Marilla, the stock price has really done nothing for the past year. And we would be adding it here for new client money, or if you don't own it, I think it's an attractive buying point. Obviously, we all know Microsoft, global software company. And once again, the threat of AI, particularly on their office productivity tools, is that going to dampen the demand for these tools? And I would argue that it's overdone because, their Microsoft themselves has an AI agent, Copilot is what they have, and they've actually layered it into their tools, and they actually have customers that are paying for it, so they are monetizing it. And as well, people forget, like Microsoft is not like some software companies where that's their sole business is providing software for one specific vertical. They also have a very fast-growing cloud computing business, Azure. And so Azure is actually growing, like last quarter, they grew, I think the top line was 39% revenue growth. And they indicated they were like supply constrained, meaning they could have grown faster, but there's not enough chips and power to do that. And they have other businesses that they have to spend money on to develop, which is positive because they're thinking about the long-term growth potential of the full company. So, if AI does well, Azure is going to benefit tremendously. So it's not like they just have one specific, point of business. And so I think that makes them a little different from other software companies. And I think, for Microsoft, they've got a very good track record of innovating and adapting over time when technology changes. They bought LinkedIn in 2016. They invested in OpenAI in 2019. And that investment is probably growing very much in value. So I think these concerns are overdone. And it's trading at about, I think, a 22 or 23 times forward multiple. And they're going to be growing their earnings in the high teens.
Okay, let's get to your next pick then, which was S&P Global from February of last year, SPGI, 535.43, 435.73 US today. So 19% drop, 18% total return drop. They do financial services. And again, all of these companies that have databases of information that they provide to their customers are at risk as well. People are worried that that information maybe not kept private, and there will be other ways to access similar information. How do you feel about that argument in a space like S&P?
Yeah, so this is exactly, you hit the nail on, that's why the stock is down 19% from a year ago. So that's primarily in their market intelligence business segment, which supplies terminals and data and analytics to the investment community. And they would argue their databases are proprietary. Large language models cannot access their database to train. And in fact, they will approach S&P to use they're saying their customers they don't want more vendors, they want less vendors. And S&P is kind of like the gateway where they can, you can access their database to do certain things, but they have guardrails to control that. And meanwhile, they also have a very profitable ratings business. It's an oligopoly. It's S&P Global, Moody's, and Fitch. And that business is very profitable, and it kind of is reflective of transactional volumes, as well as, once you have a rating out there, you have to renew and review. And so that's non-transactional based. And they're seeing good pickup when there's more M&A activity that tends to be positive for that business. And so we think the concerns are overdone, and the stock is trading at a pretty attractive multiple right now. We continue to own it.
I was going to say, are you picking it up at the lower multiple?
Yes, okay. Yeah, we are.
All right, let's get to the third pick then. Enbridge from last February, ENB on the TSX. Pipeline here, 59.46. At the time, 74.38 today. So 25% upside, 32% in total return. Enbridge, I imagine, is still doing well, even in a circumstance like today, where oil could be limited in supply. Are you holding on to this? They have a decent dividend.
Yeah, the yield's just over 5% now because of the price appreciation. It was higher probably a year ago. And they increased their dividend in December by about 3%. And we continue to hold it. As I said earlier in my comments, Marilla, that's how we've decided our investments in energy is in the pipeline stocks. And Enbridge is one of the pipeline stocks we own. And its network is vast. It's like across North America. It transports 30% of the oil that's consumed in North America. They have some gas utilities in the States they bought from Dominion a few years ago. So their cash flow streams are very visible, defensible, under kind of cost of service, kind of utility-like businesses that are generating these cash flows. And they've indicated that they can grow their EBITDA, earnings before depreciation, amortization, and cash flows, in the mid-single-digit range through till the end of the decade. And I think that they probably can grow their dividend in that 3 to 5% range as well through to 2030 for now. So strong backlog of orders. And once again, if we see some of these fiscal announcements made by the government, potential to even build a new pipeline, which Enbridge has said they're not interested in participating
right now,
unless they get some firm, concrete support from all interested parties, because they have been dampened by that in the past. So, but we still continue to hold it, and we think the yield is very attractive at just over 5%.
Okay, let's take a quick break. We will be back with more of your question for Christine Poole of Davis Rea. Back in a moment. Welcome back. Charlie is on the line in Montreal with a question today. Hi, Charlie.
Hi, thank you for taking my call. I'm calling about Teck Resources and copper in general. They were doing very well until the war began, and then they've all pulled back. I have a couple of them in copper. Do you think this is a temporary setback due to the war and a good time to probably add some more? And if so, when do you think we should add more?
Okay, thank you for the question. It's at 67.80 today, as where I see Teck Resources in Canada. What are you doing with metals right now? Do you think it's pulled back because of the conflict?
Yeah, I mean, obviously copper is in big demand with the data center build out, with electricity demand, because you need copper to conduct the current, right? And Teck is, I think if you want exposure in copper, I think Teck is an excellent investment. I think maybe the pullback is, potentially the thought that if crude oil, once again, I mentioned before, its prices stay very elevated, that we get a slowdown in growth, and potentially a more severe slowdown would be a recession. So that will dampen demand for everything, including commodities and copper. I think that's probably the reflection on the pullback. And you've seen the stocks had a huge run, Marilla. So, an excuse to take profits. In terms of commodities in general, as I indicated before, it's an area that we don't commit a lot of capital to, because the commodity cycle is very hard to predict. And then once you get that right, you have to pick the right company who is operating in an efficient manner. So we don't have exposure in the commodity space, in the copper space. But I think that if one wants to have exposure there, then Teck is a good investment there.
Okay, let's get to our next caller on the line. Les is in Kingston, Ontario. Les, what's your question today?
It's about Abbott Labs.
Go ahead.
So in the past, Christina has recommended the stock. It's done nothing in the last 5 years. One of the reasons why it dropped recently, they blame it on reduced demand on Similac and one of their other products. Does she still recommend that stock?
Okay. Do you recommend Abbott Labs these days?
Yeah, we still own it, and it has been a bit of a struggle for the company. I mean, it had done quite well, and then had that bit of a pullback. And once again, Abbott Labs, through COVID, through their diagnostics division, they did very well with the testing kits. And so obviously they were over-earning, and the stock, did very well then. And so post-COVID, it had to kind of go through that headwind, and they had to kind of report the results, with COVID testing, without COVID testing. That was a kind of a big drop-off. And so, I thought about a year ago it was really set, because COVID testing had almost had dropped off its radar now. And so once again, their businesses are diagnostics, medical devices, nutritionals, which the caller mentioned, they do Similac, and branded generics. They sell branded generic drugs to emerging countries. And we thought, I still think Abbott is an attractive investment in the healthcare space. And the market's very sensitive to any, potential weakness on results, very short-term sight, I think, that pullback. The stock's trading, I think, at a reasonable multiple, provides an attractive yield. And so I continue to own it, and I would be buying it down here.
Okay. Let's move on to our next caller. Gordon is in Lethbridge, Ontario. Hi, Gordon.
Lethbridge, Alberta, Marilla.
Oh, excuse me. I'm so used to saying Ontario. We get so many callers. Apologies for that. Go ahead, Gordon.
Oh, that's fine. Good morning, Marilla and Christine. I've been doing a lot of bottom fishing lately. My question is on Wendy's, which is in the toilet. It's been a falling knife for the past year, but I don't think they're going to go bankrupt. Should I increase my weighting in this stock? I look forward to your comments. Thank you.
Yeah, they have gone down, and I know the competition in the space has been a little stiff because people want their dollar to go farther.
Yeah, and I don't follow the stock closely, but I follow the sector generally speaking, which is why I took the question. So you're right, Marilla. It's a very competitive space, and we know the K-shaped economy, where the upper income households are kind of keeping the spending up and keeping the economy going, and the lower end households are really feeling the impact of higher rates, whatever inflationary impact on foods, et cetera. And so everybody wants kind of a value meal, and they're having to provide more and potentially charge less. So probably that's a reflection of what Wendy's stock is doing. And so we don't own Wendy's in that space. We own McDonald's. And the reason why we own McDonald's is, they actually own the real estate that most of their franchisees have their stores on. So they collect the rent. So it's a quasi real estate company, actually. And it's a franchise model. So it's really just the top. They take a royalty fee, plus they collect the rent. And McDonald's is obviously very larger than Wayne, very global. So economies of scale in terms of purchasing. And they've been implementing various value meal strategies.
Which people have liked.
They've liked, yes. Yeah. And, promotional activity with little gifts which you come in, and they seem to be working. So so in this environment, I consider McDonald's a much more defensive investment. And in fact, I think if we actually go into a growth slowdown, then McDonald's will probably hold up relatively well.
Yeah, take a look at that 5-year chart. That kind of speaks to it between Wendy's and McDonald's. There's a huge gap right now. Okay, let's get to Jim in Waterloo. He has a question today. Hi, Jim.
Yes. Hello. I'm looking at BCE. Mm-hmm. I would like your projection on what would the high be, what would the low be, and currently they're trading the mid-range. Please, what's going on?
Yeah.
Okay. BCE, I just remind people, is the parent company of the channel under Bell Media. Stock today at $35.90.
Yes. So, arguably, BCE probably has seen its low because, as you know, they had to cut their dividend last year to address their balance sheet, and the stock came off quite a bit. And then, they're kind of laid this course as to how they're going to reduce their leverage on their balance sheet going a few years out. They have an investment in the U.S. They're going to deploy fiber there, which I'm not sure about that strategy because the U.S. market's very competitive. And from what I gather, the industry within Canada, with less immigration, it's pretty competitive domestically too within that space, even though it's somewhat of an oligopoly, but it's still pretty competitive. But yesterday's announcement, they're going to build out a data center in Saskatchewan. Near term, it will increase their CapEx spending, but longer term, I think it should be positive. So I think that was a nice move, a nice investment. It's on their land, and they're going to be, the tenants or whatever it's all pre-CoreWeave is one of the tenants, so it's all taken care of. There's no worries about paying. Like if they build in the data center, and they don't have customers.
What happens with it?
It's already done, right? So it's a good move. I haven't gotten back into the stock. I owned BC like a few years ago before they cut the dividend. I'm just kind of watching to see how this is going to play out and see if there's more that they're going to be doing. But that honestly was a move in the right direction in terms of getting some more growth, I guess, into the company.
Okay, let's take a quick break. We will be back to answer more of your questions in just a moment. Christine Poole taking your questions on North American large caps. Back in a moment. Welcome back to Market Call. Marco is on the line. He's in Montreal, and he has a question today for Christine. Go ahead, Marco.
Yes, excellent. Great show as always. My question is for Christine. I own Manulife stock. Mm-hmm. It's come off recently, and I just wondered, I bought this about 5 years ago. It's for a 5-year hold. 5 more years I want to hold it for. Mm-hmm. Is it a good stock to hold, or is it kind of dead money? So thank you, and have a great day. Thank you.
Any reason you remember or recall as to why it's off? What would you say?
I'm not sure specifically why it's come off. I know it had a nice run, and maybe it's a reason to take some profits. But we don't own Manulife, but I think it's a reasonable long-term holding in the insurance space. Their growth area is in Asia. The company's been very successful in kind of growing that area of the market. And the life insurance business is pretty stable. They obviously have an investment portfolio, which time to time they might have some problems and that crops up temporarily. But it's a pretty stable type of business, and I think the stock gives you an attractive dividend yield. So it's a good longer-term hold. We just have not, in the insurance space, we've gone to Chubb, which is in the United States, a property and casualty company, which is very global and diversified in all their vertical markets. And so that's where we've committed capital in the insurance area.
Would you have any concerns holding on to Manulife for another number of years?
No, there's no concern. It's just a matter of deciding you can't hold everything, right? So you decide what what your best ideas are in this space.
Okay. Let's go to Jim then. Jim's in Toronto with a question. Hi, Jim.
Thank you very much for taking my call. What's your opinion on Constellation Software, and is it a buy at these levels? Thank you very much.
Thanks for the question. People have been waiting for a turnaround for Constellation Software for some time.
Yeah, and we don't own Constellation. We never have. Like even when it was doing really well, because I always thought it was expensive, and how they grow primarily is through buying acquisitions. Yes. And so, I like to see a bit of organic growth in the companies that we purchase. And so more recently, there is concern, their CEO has stepped down. So there was that concern because he was really the driver of that company, the founder of that company. And now more recently, the AI concerns, because they own a lot of, when they buy companies, they tend to be smaller software companies specific to certain vertical markets. So part of the problem probably, I know they've been spinning out some of these operating subsidiaries, but there isn't a lot of transparency as to, what all these little companies are and what they're doing, what kind of software they're providing, and potentially AI tools could make them less relevant. So their subscription basis goes down.
You think they need to get ahead of that?
They do. That we don't really, I don't know how much clarity they've given. They would say that probably, it's not that much of a threat, but the market is saying otherwise. And meanwhile, as you said, they go through acquisition. The company's a lot larger than they were 15 or 10 years ago. So they're having to buy larger and larger companies to maintain their growth rate. So in the past, I think valuations, they're very disciplined in how much they pay. That was holding them back because they felt that companies were trading at too high multiples, and so they weren't deploying their capital as quickly. And perhaps now that we're entering this period of uncertainty and valuation multiples for software companies have really pulled back, that maybe this is an opportunity for them. But I think what I like to see, and I think what the market wants to see that growth resume and have more clarity on what their growth outlook is going to look like a few years out, even though the valuation has pulled back quite a bit.
All right, so maybe some clarity to come from them. Let's get to an email from John. Please ask Christine on her thoughts of buying CNR. At this time, prices have dipped a little bit with the pressure of higher fuel costs and pending tariff negotiations. Should I wait to nibble at the current price? Great question on rails and what to do, right? Tariffs have been an overhang for these companies for a year now.
Yeah, for CN that was actually one of my top picks, I think, last show or a couple of shows ago, and we continue to like it. The valuation on CN has really come back. It probably trades at a discount to the group where before it used to trade at a premium. And for CN, a lot of their issues the past few years was somewhat self-inflicted. They were investing in their network. They felt they were underinvesting. And then they had some labor disruptions, strike disruptions that hampered their freight volumes. And then as well, the Canadian economy was softer than they realized. And so that also impacted the volumes. And so now the company's indicated that, they're decreasing their capital spending. They feel that they have everything in place. There's operating leverage. If freight volumes pick up, they can accommodate that growth without having to commit more capital. So I think it's attractive here. The yield's attractive, just over 2%. And we're just speculating as to what's going to happen with the trade negotiations. Yes. So I would be nibbling at it here.
Okay, let's take a quick break then. We're going to have new top picks from Christine Poole when we come back.
By lies, trapping Canadians.
She's a 19-year-old girl.
W5 uncovers a crime syndicate, hunting for traffickers.
They just asked me to find people for them?
Watch W5, Saturday at 7 on CTV and Crave.
Join us tomorrow for Market Call. David Burrows will be on the show, Chairman, Chief Investment Officer at Barometer Capital Management. He'll take your questions on North American large cap. That is tomorrow. Let's get to new top picks from Christine Poole. We're going to start with Brookfield Corp, BN on the TSX. What do you like about Brookfield Corp as the sort of parent company to the Brookfields? Why choose this way to go?
Okay, so it's, as you said, a global alternative asset manager, and they have interests in real estate, infrastructure, so think toll bridges, telecom towers, pipelines, renewable power. They're in all aspects, hydro, wind, solar, even nuclear and battery storage. And then growing wealth services management business. And so why do we like Brookfield? I mean, all those areas that I spoke of, they have operating subsidiaries that are publicly traded. But Brookfield, the parent, they will also invest their own money along with their clients' money into these various endeavors in these very vertical markets. And what makes a great asset management company? Well, you have to have a proven track record, and Brookfield definitely does. If you look at the track record over the long term and short term. They have to have access to liquidity, and they do, whether it's fundraising through funds or penetration to, they're starting to actually enter the retail channel as well. And because they're global and they're involved in so many different asset classes, in periods, I think, in times where there is volatility and dislocation, it provides them with actually an opportunity to pick up assets at a attractive price to generate long-term profits. So I think this kind of time, right, actually is actually opportunistic for them. And as well, we've talked about the data built up by the hyperscalers. Well, Brookfield, through infrastructure and renewable power, they're involved in that because they build data centers. And their tenants are like now, Bruce Slatt, their CEO, was saying it's their tenants are either governments or the hyperscalers, which is very strong, profitable technology companies. And the lease terms are like 15, 20 years, so it's very long term. And then they also can provide the power to these data centers. And you've seen Microsoft sign agreements with renewable power to supply power for their data centers. And everybody, even though renewable power, the trend kind of goes up and down, I do think long term, that is a secular trend on a growth phase. So renewable power will do well in that. Okay. So we think that it's pulled back a little bit, and I think it's an attractive entry point for a long-term hold.
All right, let's get to Royal Bank because we're tight on time. Royal Bank, of course, premier bank for Canada.
Yes.
Pulled back a little bit more lately, and
it's done well, Morel, like you said. But this pullback, I think I would be adding it for exposure in the Canadian banking sector. Of all the banks, it's the largest, probably very diversified, very strong in wealth management, so somewhat defensive amongst most of the banks. Dividend yield is about 3%, not the highest yield, but it's continued to increase its dividend annually. They bought HSBC a couple of years ago. That's been integrated in. They've realized the cost synergies, and now they're doing revenue synergies, cross-selling to their client base. So trading at a premium to the group, which it should because that has the highest ROE. But I think, a reflection of the Canadian economy, if the Canadian economy kind of does okay and they were positive about the fiscal stimulus we mentioned earlier, Royal Bank should perform reasonably well as well.
All right. I'm interested here in your last pick, Siemens AG. We had talked a little bit about something similar in the space, but why with Siemens? Why this direction?
Yeah, so they're based out of Munich, Germany, been around for years, founded originally in 1847. So like GE and some of the other conglomerates, they've been streamlining their operations. They spun off their energy business in 2020. They're in the process of doing that with their healthcare business. They still have about a 60% interest, but they're going to bring that down to less than a majority interest this year. And so they're focusing now on kind of higher margin businesses with better growth outlooks. So automation, they're leading player in that space. So Rockwell is one of their competitors. And as well as electrification. So they're benefiting from this data center build out. Siemens produces lots of products for electricity management, conduction, control, et cetera. So they're getting a lot of good orders, strong order. The backlog is growing from these data centers because they consume a lot of power. And they also have a mobility business, largest in the world. And the German government has started their infrastructure plan. They're planning to spend double in the rail infrastructure for the next 5 years versus what they spent the last 5 years. So Siemens will also benefit from that. And their yield's about 2.4%.
Got it. Last and right there.
Yeah.
Thanks for joining us, Christine.
No problem, Rob.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.